Hi, I am Jessica Irving Marshall. I'm president of Marshall Accounting Services, Moss LLC, and we're going to be doing a series of videos with hopes of helping our existing as well as new clients with some hot topic tax issues. We'll have the slides available to go with this as well. So diving into what we have planned for today, this is expensing versus capitalization of rental property. Very exciting area, and we have a lot of questions from a lot of clients about this. Everybody wants to expense everything in the year in which it occurs because it draws down the taxable income in most cases, but we are here to tell you the fun rules that the IRS has put in place to make sure that you're following code. And then our team helps to make sure that this is put into action, as well as all of the plans that we're going through. Okay, so this is Schedule E, where these are reported. Two different tax outcomes. This is why everyone wants to expense in the year in which it occurs. Deducted all in year one, fully deductible as a Section 162, ordinary and necessary, or does it need to be a residential rental property at the 27.5 years by statute. There's also cost segregation analyses, which I highly recommend as well, especially for people with a large real estate portfolio that can enable the asset classes to be strictly defined, the 5-7-year assets, a lot of accelerated depreciation, a lot of tax savings. That's outside of the scope of this presentation, but keep that in mind. 162, we refer to this is ordinary and necessary. These are the things that a business must deduct to keep running. Defined by the IRS in that section, they're Section 263A. This mandates capitalization, which means we're putting the asset on the balance sheet. We are depreciating it. New buildings, improvements, betterments, if they increase the value of the property. Treasury Regulation, citation is in there. If you can't sleep tonight, you can read the Treasury regs on that. We have the memo at the bottom where we're going to be pulling this information. So the bar test, Betterment, Adaptation, Restoration. A betterment fixes a material condition or defect that existed before acquisition. It adds to the property or materially increases capacity, efficiency, strength, etc. Adding a second story addition is on here, new parking lots paved. An adaptation modifies the property to a new or a different use that's inconsistent with the ordinary use of the property. So converting a single family rental into a licensed adult care facility. This is new. This is something outside of the original intent. Restoration returns non-functional property to operating conditions. You're fixing it, entire roof system replacement, rebuilding on an HVAC system to like new condition. The bar test. So keep that in mind when we go into here. Here's a repair. It keeps things in operating condition and does not add value. Patching drywall, fixing a leak, damaged shingles, broken windows, servicing an HVAC unit, getting it cleaned, not buying the new HVAC unit. That's a capitalized betterment. So refinishing and resealing existing hardwood floors. Another example is if you're painting the walls, must be done. Yes, you could maybe say that increases the value on for your client, but the IRS would say no to that, and our firm would have that squarely listed in repairs to keep you safe. Here are the 3 safe harbors that simplify compliance. These are especially applicable to our client base because we deal with small businesses mostly. The de minimis safe harbor, deduct items up to $2,500 per item or invoice, $5,000 if you have audited financial statements. There's no cap on the annual total. Safe harbor for small taxpayers, Treasury Reg is listed there as well. Deduct all building repairs, maintenance, and improvements when annual spend stays under the lesser of 2% of basis or $10,000. So by now you should have some bells going off in your head. Record keeping. To have these safe harbors, you need to have good record keeping put into place. we can help your bookkeepers and your team set that up. Routine maintenance on the safe harbor, deduct recurring maintenance expected more than once in 10 years, buildings regardless of dollar amount. So here's the 3 safe harbors. Annual election, you need to attach a statement to the timely filed original return. Timely filed typically always includes extensions. So if you're a 415 taxpayer, this is by 1015 if you file that extension. If you didn't file the extension and you're just late, out of luck, which would also go for amended returns. Written policy in place at the start. I can't emphasize enough with our clients. Let's get this all organized from the beginning, from the start. No annual cap, 10 appliances invoiced at $1,800 each. 18 grand, all deductible this year because of that $2,500 cap. Remember, $5,000 if you have the audited financial statements, which again, a lot of our clients don't require audits on their financial statements because they're small businesses. The SHST, this is the safe harbor for small taxpayers. So remember these 3 figures: annual gross receipts for the 3 preceding tax years, less than 10 million gross. Remember, this is gross, this is not net income. Less than 1 million, the unadjusted basis of the building. This applies separately to each building owned. So if you have a portfolio and the basis of the building for the 10 units, each is under 1 million, then you're okay. But if you've got a 2.5 million here, and really for the commercial holders where the value's in the 5 million plus, this does not apply. 2% in the 10K, this is the total annual spend on the buildings, repairs and maintenance and improvements, must not exceed the lesser of 2% of unadjusted basis or 10K. Look at my warning sign there. It's all or nothing. If you exceed the cap by $1, the safe harbor is disqualified. This should remind you of some of the work we do on QSBS Section 1202, that we're given these goodies by the IRS when they're applied correctly and when the record keeping is there and you actually qualify. So this is critical. It's an annual election. It's irrevocable. And again, timely filed tax return. So here's an example on a Fredericksburg rental, and this is where under the cap, $4,800 spent. This can be deducted under the SHST election. $5,500 spent. It's unavailable for the building that year. Every expenditure is then analyzed item by item under those BAR rules, which were back here if you want a refresher on those. Moving along, routine maintenance, safe harbor, the RMSH. This qualifies: inspection, cleaning, testing, replacing damaged, worn parts, activity that reasonably expected to recur more than once every 10 years. There's no dollar limit. The limits to know are going to be a 10-year test, excludes most major component replacements, roof system, HVAC replacement, full window package, won't recur that often. Betterments and restorations are excluded outright. So go back to BAR, the B and the R, adopted as a method of accounting, not an annual election. So this has to be applied consistently. Changing it, it's going to be changed with that same mechanism we have on the 3115 to change accounting methods. So, it's a big deal if this is changed. It's a change in accounting method. So here's the decision framework. De minimis first. Then we move to SHST, determine if the building qualifies, 2%, 10 grand. Then routine maintenance, we're expected to recur within 10 years. Only then do we get to the BAR, capitalize, depreciate. Otherwise, we can have the Section 162 repair under an ordinary and necessary deduction. Here's the errors that drive most of the audits. We get called in to do a lot of cleanup work when a client has kind of DIY'd it themselves, or they've just kind of haphazardly had their prior tax group just kind of put this in here, put this in there. So if you miss the de minimis election, it has to be attached to the timely filed return. I just have to drill down into this again and again. Date of return with extension. If you miss either, you've lost the safe harbor. Blowing through the SHST cap, again, record keeping. We work with bookkeepers and internal teams to make sure that we're tracking this. calling major replacements, repairs, full roof replacement. You're replacing HVAC, and if you end up putting in an entire solar panel system and then calling it a repair, those are the obvious ones. Again, digging into this and making sure that everything at the time of filing is accurate. Audit defense, like I said, detailed invoices. In the accounting software, we make sure that our clients have their bookkeeper aggregating these amounts correctly. The backup included in, if it's QBO that they're using, or if it's a larger non-cloud-based, really building that audit file as you go. Photographs and documentation are critical. We usually have clients put together the records that show this is what was done, these are the repairs, here's the improvements. Dated written expensing policy. Again, we can help clients to look at what this looks like, help them draft this expensing policy. And this is for de minimis reliance. It needs to be a written accounting policy. And then we need to be consistent with the RMSH treatment. And this is, like I said, an accounting change. It's an accounting type. And so if you change this, it does require the timely filed Form 3115. IRS can get clients on a lot of these. And so we go into a lot of audits where it's just a losing situation. Our team wasn't involved. It's more of a cleanup to determine how do we mitigate these damages and get this cleaned up in the best possible way. There's fines, underpayments, penalties, plus the cost of our team on the CPA side, the tax attorney. Some of these audits can run in cost to clients anywhere from 20 grand to 65 grand in the accounting and the legal fees just to get through it. Here are the takeaways, which I have gone through. And again, we're going to make this available to our clients. There's our information. To people who are not our clients, you are welcome to use this information. We have a great network of accountants, bookkeepers, financial advisors that we work with and we recommend. And we look forward to giving you more of these videos that I know probably are very boring, but I promise it is important. And it's more important to avoid falling into these audit traps and needing to call our firm on an emergency basis. Thanks, and we'll see you next time.